something called a tax shield. Now, if you're in accounting, you may have heard of a tax shield before, or even in finance. A tax shield is any time that you save money on your taxes because of an expense, right? We know that expenses lower our profits. Expenses lower your profits. And if your profits are lower, your taxes are lower. So expenses decrease your taxes, right? That's called a tax shield. And there are many different tax shields. There's interest tax shields. There's depreciation tax shields, which is what we're going to be looking at in here. So because we're dealing with a capital investment, and we talked about in the capital budgeting chapter that a capital investment is a purchase or an investment in a capital asset, like a building, machinery, equipment, that sort of thing. Well, these types of assets depreciate. And depreciation is an expense that you put on your income statement. And therefore, just by owning these assets, you are saving money on your taxes because of their depreciation. We call that the tax shield. CCA stands for capital cost allowance. It's just what we call depreciation in the tax code. So the first thing I want to show you guys is how you calculate a tax shield. There's two different ways to do it, and this really depends on what they decide to put on the exam. The straight line method, which is kind of simpler. And then there's the depreciation using the actual tax code, using the rates. That one's a little bit more complex. You'll want to clarify with your prof which one you should be focusing on. I'm going to show you both of them. So the straight line method, just like in any accounting class, is where you depreciate equally. But depreciation using rates is where you're depreciating using a declining balance method. Okay. Don't worry about that just yet. I'm going to explain this all to you right now. Meet me over here on this first example. So you bought a truck on January 1st, 2024. You paid $100,000 for it. The truck is expected to have a useful life of 5 years and then sold for $22,000. That is what we call the salvage value. So you believe that after 5 years, you'll be able to salvage $22,000 from it. The truck is class 10 with a depreciation rate of 30%. The tax rate is 40%, and the cost of capital is 10%. The cost of capital is your K. So using the straight line method, what is the annual CCA tax shield? What is your annual depreciation tax savings? Step 1, get your CCA. And for this, we're going to use the cost of the asset minus the salvage value divided by the life, just like you would have done in your financial accounting class. So cost of capital, 100K, or capital cost, the cost of the asset, minus the $22,000 in salvage value over 5 years. Your annual depreciation is $15,600. Okay, that's per year. Now, this is not the answer. This is just your depreciation, right? On your income statement each year, we're going to see a depreciation expense of $15,600. The tax shield is found by taking that CCA and multiplying it by your tax rate. So if you have a $15,000 expense and your tax shield is 40%, then each year you're saving $6,240 from your taxes per year. This is your tax shield. This is your tax shield. Every year you're going to save $6,240 on your taxes. And then the third part is, what is the present value of this tax shield? So because ultimately we're finding a net present value, that's the whole point of everything we're doing in this chapter, you're always going to have to find the present value of everything. And since you have a tax savings every single year for 5 years, what we have here is an ordinary annuity, right? Imagine that you see this on a timeline. Every year for 5 years, you are saving $6,240. So it's as if you're making $6,240 every year for 5 years. So I want to find the present value of this ordinary annuity. You can use your formula. You can use your financial calculator. It's totally up to you. I'll do both. So using my ordinary annuity formula, and by now I imagine that you guys are very comfortable with this and we're not reviewing what an ordinary annuity is. You can always go back and see that. So we'll take our payment, multiply by 1 minus 1 plus the discount rate to the power negative n, over the discount rate. On your financial calculators, your payment is 62.40. Your I over Y is 10. There's no future value here. N is 5. And you compute the payment. You compute the present value, excuse me. So 23,654 and 51 cents. That is the total present value of your CCA tax shield. So all your tax savings over the next 5 years today are worth $23,000. Now this is going to be a step in a question. It could be a standalone question, but most of the time it's part of a larger question. So this is how you would do it, guys, if you're using the straight line method to depreciate your assets. If you're using depreciation rates, it'll be completely different as far as like the procedure. We're going to make a table here. Time 0, 1, 2, 3, 4, 5. And I want BUCC, CCA, EUCC, and then here we'll put CCA multiplied by T. Okay. UCC, when you see here UCC and UCC, it stands for undepreciated capital costs. You've got it right here. It is basically what in financial accounting we call a carrying value. It's the value of your asset minus all of its depreciation. B and E just stands for beginning and ending. Beginning, undepreciated capital costs, so at the beginning of the year, and ending at the end of the year. So this is how you use a table like this. At time 0, that's the day you bought it. You have nothing here, and we're going to put an ending UCC of the price you paid. And the ending becomes the beginning of the following year. So the following year we'll start with 100. And now the CCA is calculated by taking, and I think I wrote it, the beginning undepreciated capital costs multiplied by your CCA rate, right? So you'd be doing the CCA rate here is 30%. It means your asset is depreciating by 30% per year. But now focus, because the next thing I'll say is where everyone forgets. In the first year, you can only use half the rate. It's called the half-year rule. When depreciation is found using the depreciation rate, the first year of an asset's life can be depreciated by half the usual rate. Only in the first year. It's in the tax code. And basically, even though our CCA rate is 30%, we're in the first year only going to take 15%. So your depreciation in year 1 is $15,000. And then you subtract that from, not from there, excuse me. You subtract that from the beginning. So 100,000 minus 15,000 gives you your ending. You see? Now, after 1 year of depreciation, this, was it a truck? This truck that you paid 100,000 for is now only worth 85. And then this becomes the beginning of the next year. And then for every year moving forward, we use 30%. So now your depreciation in the second year is 25,500. And now if I do 85,000 minus that, my ending balance is 59,500. And because I asked you for the CCA tax shield in each year, we're going to complete the table. Now, on an exam or in a larger NPV question, you very often do not have to do each year. But you need to, you should know how to. Like if I were to say, what is my CCA in year 4? Well, you have to go through this process to get there. So we're going to fill up the entire table just for practice. So my ending becomes my beginning. I multiply that by 30%. My depreciation in year 3 is 17,850. Take that away from the beginning balance. You get 41,650. That goes down to the beginning of the next year times 30%. 12,495. Take that away from the beginning. $29,155. That then goes to the beginning. And we have our depreciation expense. I'm going to round this one because I don't want to have any decimals. For each year. And it's right here. Now, the question didn't ask you for the depreciation expense. It asked you for the tax shield, and that's why I added this extra column on the right. If you wanted the tax shield, you would take your depreciation expense and multiply it by your tax rate for each year. So that would be 6,000. This one would be 25,500 times 0.4 is 10,200. Okay, then the next one, 17,850 times 0.4 is 7,140. 12,495 times 0.4 is 4,998. And 8,474 times 0.4. 33, again 90 if I round that to the nearest dollar. So your tax shield in each of those years is right there. Okay. What is the present value of the tax shield? If you're using the tax rates, there's actually a formula you want to follow. It's a bit of a doozy, and you have it right here. This is the formula for the present value of the CCA tax shield. Again, only if you're using depreciation rates. If you're using the straight line method, you do it the way we did here as an ordinary annuity. Okay, so I want to show you how to use this formula. And this is most likely what you're going to be doing on the exam instead of making that entire table. So C0, that's the cost of the asset, right? So 100K. D is your depreciation rate. That was 0.3. T is your tax rate. That was 0.4. Divided by D, that's 0.3. K is your discount rate, or cost of capital, which I think it was 10%, yeah. Times 1 plus 0.5 times K, your cost of capital, over 1 plus K. Minus the salvage value, which was 22,000. Times your depreciation rate of 30%, times your tax rate of 0.4. D plus K times 1 over 1 plus K, and your K here is 10% to the power N was 5. So it's a long one. Now, in a lot of questions, you don't have a salvage value. If you don't have a salvage value, then the entire right side here gets wiped out, right? Because if this is 0, well, then the whole thing is 0. But when you do have a salvage value, this is it. Now, I suggest, unless you're very good with your calculator, by now you guys are, I imagine, are pretty comfortable with your calculators. But if you're not, don't be afraid to put extra brackets here, 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 really everywhere. Like an extra bracket is better to have too many than not enough. And you can also just do it in parts. Now, doing it in parts is good, but you introduce a lot of rounding. So I'm going to try and do this in one shot. Okay, this is not so bad. This first one gave me exactly 30,000, so I'm actually going to write that. Then 1 plus 0.5 times 0.1 divided by 1.1. Yeah, so you see this one gave me 1.0454545. And if I'm going to do it in parts like this is how I'm doing it. I'm keeping many, many, many decimals. Then 22,000 times 0.3 times 22,000 times 0.3 times 0.4 divided by 0.4. This bit here gave me 6,600 even. And then 1 divided by 1.0, no, 1.1 to the 5, 0.620923. I'm just taking all my decimals. And then we can start putting it all together. Now, so you put all of this together, you should get a present value of your tax shield equal to $27,265.56. Okay, so take your time with it, slowly. And again, what this means in the context of what we're doing, the present value of all of your future tax savings are worth $27,000, and we treat this as an inflow. And you'll see once we do our big case, guys, this is money coming in. Even though you're not literally receiving money, when you save money, it's the same thing as getting money. So this is going to be considered an inflow of cash when we're evaluating this investment.